if you look at the market right now and you look at historically, and I thought this stat really caught my attention, is the S&P 500 over the course of the last couple of years has really been driven by growth, meaning it's just price appreciation, right? You buy a stock and the stock prices go up. And I think the yield on the S&P 500 is like 1.2% right now, which is very low. But historically, going back to the year 1987, Chris, which is a good year for you, I think you were 7 years old.
I was. Good math.
There you go.
1980 minus 1987 is 7. That's good, Rye.
That's good. That's good.
I appreciated 7 years at that time.
That's good data, Chris. That's good data. But the point is, if you go back to 1987, the S&P 500 returned, it was 55% of the return came from dividends. And clearly right now, where the money's going, right, whether it's crypto, gold, Nvidia stock, or the S&P 500, you're getting zero to very, very little cash flow on your investments. But we know historically that income is the biggest driver of return. And, it's kind of an interesting time, Courtney, because, from our perspective as financial advisors, we see like, wow, there's so many places to put your money that are cheap. They pay lots of cash flow that historically are probably, based on history, probably do better than being in that momentum trade right now, yet that's not where the money's going.
Yeah, and for some reason, I find that investors have a really hard time grasping this. But let's use a different concept here. Let's say that we're looking to buy a property, right? So you have two options. You can buy a house that just went up 50% in price over the last couple of years, and you can buy that. Or you can buy a house that actually has gone down in price last couple of years, and you can rent it to somebody who's going to be paying you every single month in rent. Like, what I'd want to do as an investor is I'd want to buy the cheaper one where I know I'm going to get income and wait for it to appreciate in value. In the meantime, you can probably keep increasing rents as inflation goes up. And that's the same way it works with your investments is you want to get dividends and you want to be buying the things that are down. But for some reason, when it comes to the stock market, that logic goes out the window for a lot of people. But that's really how you want to think of it as an investor.
Yeah, Corey, I agree with that. I was looking at a great stat today. Of the top 10 all-time best performing stocks, 8 of those 10 not only have paid a dividend over the past 60 years, but have consecutively increased their dividends. So an increasing cash flow investment is always a great thing, to your point about real estate and owning cash flow stocks.
Well, this is the incredible thing about stocks, right, and investing is think about Nvidia, right? That stock, and I gave this out last week on the podcast, it's up 1,000% over the last 3 years. 1,000%. That is an insane return. So to think that Nvidia is going to repeat that over the next couple of years is, the odds and probabilities of that are so minimal, right? Because we know trees grow to the sky. We know that there's creative destruction. And again, we know long-term, it's really boring cash flow investments that actually outpace whatever the hot technology stock is, right? You would think long-term, like take a stock like IBM, which has been around since, I think, the 60s. You would think since it's a technology stock, it would have outperformed a lot of other boring industries. Yet the best performing stock of all time is Altria, or the formerly known as Philip Morris, a cigarette company, right? And it's because they pay so many dividends. In fact, 80% of the return long-term comes from dividends, not capital appreciation. And yet investors want to buy, like, Corey, this is such a great point. They want to buy what's already up massively. Meanwhile, the odds and probabilities are stacked against you for that performance to happen again. Yet that's where everybody wants to put their money right now.
Well, not everyone. Let's take a look at Warren Buffett. So he actually has these filings that come out that shows what stocks they're buying at Berkshire Hathaway. And over the last couple of quarters, they have not been buying Nvidia and Microsoft and Google. What they've been buying is things like home builders, which are dividend-paying stocks. And they've been buying things like healthcare companies. Like, these are some of your boring dividend-paying stocks. And I think what you want to do is say, maybe he has something right here. Maybe he's looking at what's going to be the long-term trend, and he's buying those lower valuations, higher dividend-paying stocks here. And I think that's somebody you want to take an example from.
Yeah, Chris, I don't know. The question is Warren Buffett lost his touch, right? Like, maybe he's just missing the boat here, not buying Nvidia, or are all these talking heads on TV, and Courtney can attest to this, that are pretending like they've been bullish now for 3-4 years. It's a pet peeve of mine. Yet they were talking about recession and being out of the market for several years. Now just act like they've been all in on this tech trade, and they're telling you to continue to buy Nvidia, continue to buy Apple, continue to buy Amazon, Google, et cetera, et cetera. Who's right, Chris?
I actually think Warren Buffett is actually secretly following the Payne capital model. He's taking profits from those things that have done so tremendously well. and buying into things while they're undervalued that generate great cash flow. That's a play out of the Payne Capital playbook.
No, of course, it's almost like too obvious, right? It's too obvious when you look at the stats that tell you that long-term, boring companies like cigarette companies do better because of their dividends. Right now, we know just long-term, we have a housing shortage in this country, right? We're about 2 million houses short. So, and rates are coming down, which benefit home builders. This is like common sense stuff to think about. Meanwhile, you have people betting on the new currency could be crypto in the future. We don't really know. This world disorder might be happening right now, which is kind of like science fiction. Yet we know these more common sense ideas. And the smartest investor of all time is putting his money there right now. Like, why don't people get it?
I think that's just human nature. I think that's just how investors have been, probably will always be. It's probably why we have a job, which is, that's a bonus. But I think this is why we want to put this information out there. You do want to think about this common sense. It's really easy to have that fear of missing out, to hear the hype of what your friends talk about. Oh, they made so much money in Bitcoin, or they made so much money in Nvidia. They tend to tell you about all of their winners and not about all of their losers. And the same thing with people on TV are going to tell you the same thing. But you want to make sure you own everything. You want to have that common sense strategy. And that's really, why we're out here talking about this.
Yeah, I agree. And, there's a lot of practicality to this, especially when it comes to your financial plan. I can remember, and you guys probably remember all too well, back in 2020 in March when, the S&P was down almost 40%. Clients still needed to take money out of their portfolios. And guess what? Companies were still paying dividends. We were still getting cash flow in the portfolios. So we were not only able to distribute that money, but in a lot of cases, we were able to reinvest back into the market when it was down substantially. So, there's so many benefits to having cash flow. And, Bob's not here today. He's on vacation in Italy. So we're going to use a Chrisism, and that is you get a better outcome with income.
A great point. And what blows my mind right now is baby boomers that are dependent on their portfolio. And we look at probably more portfolios a month than anybody. They're like all in on the tech trade as well, right? They're not buying income investments. And a lot of times we're seeing folks that are in their 60s and 70s, and they're like 70, 80% at risk in the markets. Court, we saw this with a recent case we worked on. And a lot of that money is, again, all in these no income paying, high growth type of investments that we know when the party's over, the music stops, can go down dramatically, right? There's been years where Nvidia has gone down like 70, 80%. It was down 50% just in 2022. And I think that's what scares me the most is, you have a lot of people that are going to be more dependent on their portfolio. They're taking too much risk, and they're missing the biggest buying opportunity ever where the income is really rich and not richly valued.
Yeah. And I get this argument a lot where people will even know that they have too much risk, but they're saying, well, I'm going to wait until it stops going up, and then I'm going to take the risk off the table, and then I'll add to these other things. But the problem is, like, timing this is next to impossible. And I think this is a really good time to just acknowledge how well the markets are doing, how well that AI trade has been doing. So, you know what? We're not saying get out of them. We're just saying take some profits on those things and add to these other areas that are cheap right now. They may not be cheap when you're looking to reallocate them later.
And that's a great point, because the analysts aren't going to get it right? If you look at it, most analysts have been tripping over themselves to keep raising their estimates because they didn't anticipate how powerful the AI or artificial intelligence trade was going to be on the upside. They'll be late on the downside too. When the party's over, they'll still be raising their estimates. That's what happened when the tech bubble burst. Is the analysts were still optimistic going into 2021. Meanwhile, earnings were about to fall off a cliff. So I think the point here is you want to be proactive, not reactive. Anyone says they can time the market, well, I got a wall in China, I want to sell you. They're not going to be able to do it. Now's the time to make those adjustments. Now's the time to be proactive on your portfolio. As the famous Chris Payne once said, you get a better outcome with income. Hey, hope you're enjoying the most recent episode of the Pain Points of Wealth podcast. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million for your retirement, Bob, Chris, Courtney, and I will run for you our total financial master plan, and we'll do that with no obligation or cost. It's a full holistic review. We literally look at everything. We'll go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life and hone in on every financial issue you need to address today, whether it's an income plan for retirement. How do you take Social Security? How do you draw from your portfolio, factor in inflation, and don't run out of money? We'll look at diversification. Markets have been wild over the course of the last couple of months. Has your portfolio been up and down? Or have you been sitting in cash, CDs, money market funds, paralysis by analysis? We'll put together a full investment game plan. We'll show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products, whether it's an annuity, mutual fund, insurance product, structured product. We'll do a deep dive of every investment you own. We'll show you how to reduce the cost and optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get a full tax playbook, and we'll do this full review at no cost. We'll literally go through everything for you, do all the work up front. Simply go to www.paynecm.com/financial plan or click the link below to see if you qualify for a free financial review. You know, guys, one of the big debates on Wall Street right now is, and it's kind of interesting, and I think a lot of this is shockingly politically motivated. I know that's shocking to you guys. Is the economy really slowing down? And there's so many strategists on TV, the same people that have been wrong now for years, by the way. Let's put that caveat out there. The drumbeat going again that we're actually seeing a slowing economy. I don't know, Court. I'm suspect. What are your thoughts? Economy heating up, or is it actually slowing down right now?
Yeah, there definitely is conflicting data. And I think that's where people are confused about this. And some people will latch onto the negative data and say, oh, everything's going down. And then some people latch onto the positive and say everything's going up. What we try to do is just look at it as an aggregate. You want to look at the government that's provided by the government, that's the data that's provided by companies. But all of these are going to look very different. And I think when we look at this in aggregate, so you look at how GDP is growing, how the consumer's holding up, where the labor market is, it really seems like the economy is in very good footing right now. We do not seem like we're going into recession anytime here soon. And I want to continue to see how that data comes out, but that's really what we're seeing.
Well, this actually brings up a really good point, though. So, one of the big questions that everyone's been talking about is the labor market. A lot of the numbers have been revised downwards, right? Saying that we hired much less people than the original data said. And we know that Trump, fired the Bureau of Labor Statistics head. And of course, they put someone in there from the Heritage Foundation, which maybe it's a questionable economic, foundation. We'll just say that, Chris.
I can't believe you'd say that.
So maybe these numbers are being manipulated, but do you think that the labor market really is slowing down, or is this just like political, gamemanship with the numbers?
Yeah, I don't know. I mean, Trump has been putting very consistent pressure on Jerome Powell to lower interest rates, and all of a sudden they replaced the head of the BLS. So the data is a little bit more in favor of a rate cut. I don't know. It could be coincidence, but I'm thinking it's a dubious proposition at best.
Well, let's also think about the fact that this data is backwards looking, right?
Yes.
So this is looking at how companies were hiring the last couple of months. And this was in the midst of all of the tariff turmoil. And the last thing companies were doing is hiring more people when they're trying to figure out the tariffs are on one day, they're off the next day. Are their costs going up? Are they not? Like, what you're going to do is you are not going to be hiring people until you get some sort of clarity. And I do feel like we're probably getting there at this point in time, but you're not going to see that reflected in the data till the next couple reports. So I actually don't think it's that odd that you're seeing this right now, but I don't think it's necessarily a sign that the economy is falling off a cliff.
No, it's such a great point, right? Think about this from a common sense perspective. And that's a word that politicians love to use today. It's common sense. And that is just that, like, if you have a company right now, right, and you're starting to figure out tariffs, and let's just say you start to figure that out, your profits are going up. We know that the profit cycle still looks good, right? We're looking at positive earnings again next quarter, the following quarter, even into next year. So your business is doing better. When your business is doing better, then you hire, right, after the fact. So I think the fact that we see this slow patch right now is not indicative of where we're going. That's where we've been. And furthermore, if we're looking at forward-looking data, right, the stock market's forward-looking data. The stock market's going up because it's pricing in that things are getting better. And the economy, if we look at this quarter right now, it's tracking at a 3% growth. That's much higher than the first half of the year. So if you really look at all the forward-looking indicators, and it's like this kind of common sense, right? We're not looking, this is all like traditional economic data to look at. Going back to what you said already, Courtney, reading the tea leaves, is the economy is actually getting stronger, not weaker. So, Chris, the question really becomes, and it looks like the Fed probably will cut interest rates. Are they spiking the punch bowl at the wrong time here when the party's heating up? When really you should take the punch bowl away. Like I've seen you at parties, Chris. We always know when it's time to take that last drink away from you.
Yeah, I mean, I think really what it comes down to is how much the Fed will actually cut interest rates. I mean, I think if they a little bit more modest about it, I don't see really a long-term problem. But if they cut too much, we could be in a situation what happened when they cut last time, where longer-term rates do go up, and we do start to see inflation. Because when they do cut rates, the economy could heat up.
Well, that's it, right? You start to heat up an already hot economy. And I think that's the biggest risk here. And we think about risk assets right now, like clearly right now, the animal spirits are out. Whether we're starting to see those SPACs, special purpose acquisition companies coming back. They're just blank check companies. They're going public again. The IPO market's heating up right now. If you look at options activity, which is speculative activity, that's heating up. We mentioned last week, you have $1 trillion in margin debt. That's just people borrowing against their accounts to buy more stock. It's kind of like when everyone was borrowing against their property, going back to the mortgage analogy, Courtney, again, during the housing bubble, when everyone was borrowing to buy more houses. So you're already seeing a lot of that behavior right now. So the only crude tool the Fed really has is interest rates. And if they start to exacerbate that speculation, that could be a big problem, no?
Yeah, I mean, it really puts them in a tough position because that's what they're trying to figure out is they don't want to cut too much and overstimulate the economy because there is a real risk of that happening, which we talk a lot about on the podcast. But then on the flip side, you get this labor report that comes out and people are now questioning, is the economy slowing down? Are they too late to cut? And so, they're trying to figure out where to go here. And I think it's really widely expected they're going to be cutting interest rates next week. But people are really starting to question what's happening later this year at this point. So people were thinking they were going to be cutting probably 3 more times this year. Now it's okay, probably in September. We don't know the rest of the year. So that's what we have to see happens.
But it also speaks to being proactive in your portfolio, right? And this is, again, why this melt up could happen, because a lot of us are still sitting with CDs, money market funds, which were paying 5%. Now they play closer to 4% because the Fed did cut last year and they keep cutting again. Now you're down to like 3.75% or 3.5%. We know if you're trying to solve for retirement, that ain't going to cut it. So when you're thinking about building a portfolio, coming back to our first segment today, like for income, it's a good time to start locking into some yields, not short term, but longer term before the Fed actually cuts, right? And buying those dividend paying stocks as a supplement for your income that increase over time. This goes back to our pain point. Diversification is the only hedge against uncertainty. And there's a lot of uncertainty right now. And no matter what happens, the Fed cuts, we get a melt up in tech stocks. You really have to protect yourself and spread your money out more than ever right now. This is the time to do it. Don't wait. As always, it's better to be proactive, not reactive when it comes to your financial plan.
Thanks for listening to the Pain Points of Wealth. Hopefully you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at bebullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Pain Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.